Friday, June 6, 2025, Monaco 64, home of alternative economics and contrarian views. Good morning, Clive. How are you doing?
Well, good morning, Mario. Just in case some of your viewers are wondering what I've got on my face here, I haven't been in a fight. I've been to the doctor, and he's used this ice cold spray they put on your skin to remove, I don't know, little bumps and things. So
Yeah.
that's what it is.
So you haven't been in a fight with Elon Musk?
Um, no, but he seems to get himself in trouble, doesn't he?
Yeah.
Apparently, the president is not too happy with his words when he called the big beautiful bill an abomination.
Yeah, and well, let's get to serious things now because that's all theater, as we know, Clive. Um,
hmm
I have a question for you. I was thinking this morning what I'm going to ask Clive, and the question is, has silver joined the party, i.e., the gold party?
Well, those who follow me on LinkedIn yesterday would have seen yesterday, within seconds of the silver price passing $35, I put up a post on LinkedIn saying, "Hey, everybody, it's just past $35. That's the level at which everybody thinks that silver's going to enter a new higher territory." And I think we were looking like we're going to go through $36 this morning. Maybe it's already happened. So, do I think it's going higher? Well, I think yeah, I think so. We've still got the supply and demand equation, which shows quite clearly, according to the Silver Institute, that the supply of silver continues to decline, and the demand for silver in industrial use continues to rise. And we passed a couple of years ago. I'll just turn the phone off there. A couple of years ago, we passed the point where uh, demand exceeds supply, and that gap is getting bigger every year. So I think silver's well supported by that. Of course, there's a lot of above ground silver which could come out at a certain price. So it's difficult to say whether it will shoot upwards. It's called kind of a race between the speculators and the grannies who are rushing down to the pawn shops to cash in their silver candlesticks. But probably in the short run, it goes higher.
Yeah, I'm not sure grannies have that much silverware anymore, but I know what you mean. So here I've got the a chart here. I saw your chart. Yeah, I mean, I was waiting as well, like you, because that 35 level. I mean, the high here that we had back in October last year wasn't even it was just below 35, but for some reason 35 is a round number, and I think the futures might have reached 35 last year. But yeah, it's definitely squeezed up. We saw yesterday late afternoon European time, Clive, that gold, silver and gold came off a bit, but this morning, as I look here, we are see silver is at 36.15, the spot up 50 cents.
So
Uh,
we've broken $36. That's
yeah. The high is 36.22 on the spot. So
uh,
yeah, go ahead.
if we go back to 1980, when the Hunt brothers were trying to corner the silver market, the price of silver reached $50. And the price of gold at that time was also at an all-time record. I think it was 840 or 880 dollars, something like that. So at that time, we had a gold or silver to gold ratio of 17 times. In other words, 17 ounces of silver would buy you an ounce of gold. Now, right now, the gold price is 3,400. So, in the unlikely event that we get to a 17 times ratio, it means silver would have to go up to $200. Now, I'm not suggesting for a moment that it's about to do that, but it certainly tells you that silver, which last week was 100 times the gold price, oh, sorry, gold, which was 100 times the silver price, tells you that silver is relatively very, very cheap compared with gold, and there's potentially a long way for it to go.
Yeah, I've got here the gold silver ratio, and it's really collapsing now. I think it's on its way down. Of course, it's not going to go down in a straight line, but it looks like this was like during COVID when it spiked to like how much was it? 100 and let's have a look, 120 something, 126. and then it started collapsing again. I think we could be entering that kind of scenario. Could, nothing is ever certain in the markets. And I think I can go back here to 1980. Oh, no, I can't. But yeah, I think if you take the high in gold, that was 887 in January 1980, and the high in silver was around 50. Like you said, it was around 16, 17 to 1, which historically, excuse me, has been the average. Uh, I mean, in 2011, we got down where is it? I don't, yeah, we got down to 31 or thereabouts. So there's still a long way for silver to catch up. And I think, Clive, I asked you, has silver joined the party? And I think the party was pretty good already with gold. But when silver joins the party and comes to the party gets even more wild, I think. Um, so
Yeah.
we need to be ready for a lot of volatility, especially in silver.
There's another thing which I think a lot of people missed yesterday. As silver jumped, so did platinum.
Oh yeah,
Palladium did nothing. And I've noticed for quite some time, platinum seems to be dancing. We're talking very short term on a daily basis. Platinum seems to be dancing with silver. Silver has a spike, platinum has a spike. So yesterday, platinum did extremely well, as silver did well. And of all the metals, platinum has been a long term underperformer, perhaps in a certain sense, even worse than silver. Certainly for a year or two, it's been worse than silver. So, those who feel they're missing the party, there's precious metals which haven't performed yet as well.
yeah. Here, oh, sorry. Here's platinum. Yeah,
So you can see the leap yesterday, or was it about
yeah,
5% yesterday or something like that?
yeah. So yeah, yeah. The next target is going to be here at 1,330 or thereabouts.
So
And
that's another 20%.
yeah, I mean, back in 2008, it got up to 2,300 almost, and gold at the time was at $1,000, so it was worth 2.2 times more than gold. So with gold at 3,400, 2.2 times is yeah, there is a lot of potential for platinum, even though I think the industrial use for platinum, like catalytic converters, that's gone down with the advent of electric vehicles, but you never know. I saw a post by Francis, who was with us on the live stream on Sunday. He said that platinum is even more on. He thinks it's even more undervalued than silver. Anyway, I don't have any platinum. I think it was your granddad or your dad had a platinum ring.
Yeah, his wedding ring was platinum, and he always used to show off to his friends that his ring was platinum because the price was worth much more than gold,
Yeah,
whereas most people had the gold ring. So he was really happy about that. Unfortunately, I've no idea what happened to the ring. I've never seen it since. Well, my father's deceased, but
yeah,
yeah, but he was very proud of that platinum ring because in those days, platinum was worth a lot more than gold.
yeah. No, just want to show a chart of gold before we go into another topic here, because even though we're focusing on, well, I haven't got the chart of gold, but the chart of gold still, I'm going to bring it up. Still looks good too, I think, Clive. It looks like we could be breaking out on a weekly chart. I've got it. Let's see. This is the monthly here. I'm gonna bring this up. I think it looks quite bullish as well. And in the past, I've been saying that a major bull market in precious metals, you need to have silver leading. So I think it's going to get even more interesting with gold. So that's the weekly. So we've had like a 7 weeks basically of consolidation. So it's kind of made it less overbought. It's bought the moving averages, the price back to the moving averages. So yeah, I think if we close above this high here of let's see, 33.66, which was May 25th, it could be quite bullish going forward. So, wanted to talk, Clive, now about Trump, but not not his jewel or his new enemy Elon, but about what he said about the debt ceiling and the debt limit. And I'm going to bring up this article, and I want to know your opinion on it. What you think? Is it a good idea to scrap the debt ceiling or debt limit entirely? And Clive, this debt limit was created in 1917 when they started issuing these war loans, Liberty bonds during World War One. Clive? Oh.
I'm here. I'm listening to you. You went silent for a second. I don't know if it's that you stopped
No,
talking
it's just
or.
I wanted to know what you think
Oh, okay.
about.
So, first of all, they've renewed this debt ceiling countless times. I think it's over 90 times it's been renewed every time they raise it.
I didn't get that, but could you restate the question?
Sorry, my watch was talking to me. I don't know if you heard that. So they've renewed the debt limit about 90 plus times, and I've no doubt again that they'll renew it again, probably in July or August. Um, Take my watch off because it seems to be listening to me, and I don't like that very much. So anyway, we are in a debt ceiling at the moment, and we've hit it because that happened on the 2nd of January this year, and therefore the government can't borrow any more money. So to pay the bills, they're using what's called emergency measures at the moment, where they run down the cash balances and suspend payments into government pension plans to keep paying the bills. But if they get past July or August this year, there is a risk of default. It's a very low risk. The credit default swap market says the risk is about 0.79%, slightly less than 1%. So pretty low risk of default. They'll probably raise it in July. Now, if they, one of the features of a debt ceiling is that foreign governments who invest in treasuries, at least to some extent, know where they stand. They might not be happy about the debt going up and up because they're buying these bonds, and then by the time they mature, there'll be even more debt than there was. But at least they know how far it can go. But if the debt ceiling is completely cancelled, well, in theory, there's absolutely no limit how high that debt might go. So if a foreign government buys a 10-year bond and there's no debt ceiling, who knows? Maybe the debt will be 100 times as much by the time that bond matures. And of course, if that were the case, that bond isn't going to buy very much at all. So I think as a foreign government, it would be just another nail in the coffin for me when it comes to making US Treasuries an attractive investment. I'd be once again saying this is yet another reason why I need to diversify into other things. And one of the obvious things to diversify into at the moment is quite clearly gold, because every other central bank is buying gold. So why wouldn't I?
Yeah, and I saw a tweet or post here I think it was this morning from Gold Telegraph. I'm going to bring it up, Clive. Uh, it says breaking news. Central banks worldwide are on track to buy 1,000 metric tons of gold in 2025. I think they've been buying that kind of amounts since 2022, and 2022 was a record amount in the post 1944 era. So this is huge. They're not stopping, and central banks don't care too much about price. They just want to have the physical possession of it.
I did a little bit of maths on where the deficit is going to end up at the end of this fiscal year, which ends in September. We will have a deficit, or the US government will have a deficit of over $2.1 trillion at the end of the year, based on the Congressional Budget Office's statistics projected forwards. So when I looked into it, I found that the tax increases, they've increased the taxes by slightly, or collected taxes of slightly less than 5% more than last year, up till now. That's up until the end of April, or is it the end of May? Up to the end of April, it was, in fact. But they've spent roughly 9% more than they spent last year. So they spent 9% more, but only collected less than 5% more. So the net result of that is that the deficit for the year is going to be something like 20% more than it was a year ago, which brings us to a figure of $2.1 trillion of deficit for the current year, which will be the highest ever. And that figure is going to be, based on everything we can know, probably $500 billion higher in the fiscal year 2026, if assuming that this big, beautiful tax bill gets passed by the Senate.
Yeah, and I guess that deficit 2.1 trillion is around 7% of GDP, which is normal. It was normal during the great financial crisis or the pandemic when they go all out to try to get the economy going again, or during wartime, but not in the supposedly peaceful, prosperous environment. It's huge. Can you imagine, Clive, if we do get a recession, how much higher that would have to go? And that's one of the reasons why, Clive, when I because a lot of people think that if we have another recession, that bond yields are going to collapse. But I think it could go the other way because it means that the governments are going to get less revenue. They're going to have to start printing more. So I'm not too sure. And it seems like even the people who in the past have been bullish bonds, they're starting to get bearish. I saw this article a couple of days ago or yesterday, actually. Well, yeah, it was yesterday. Global bond auctions show weaker trend as fiscal angst grows. So they're talking here, Clive, about how current auctions haven't been going very well, not just in the US, but also like in Japan, in Australia, and even in South Korea. And so that's why I think even if we have a recession, don't be don't be fooled into thinking that bonds are going to go up, especially long dated yields. And there's something interesting here. A global gauge of long dated yields at highest since 2008. So there you go.
Markets anticipate the future, and I think it's quite clear that with the growing budget deficits, the US government debt, which is growing faster than the economy, faster than GDP, in other words, and the fact they're going to have to raise a large amount of money immediately after raising the debt ceiling in July or August, it probably means that the markets will start to anticipate higher government bond yields down the line rather than lower. So even though it's very likely we'll see some interest rate cuts from the Federal Reserve, that is priced in more or less, priced into the short end, we'll probably have a situation where the short-term interest rates are falling and the interest rates or the yields on the longer bonds are rising. And I think that's just a reflection of investors' discomfort with the fact that they know we get to a point where the Federal Reserve is going to be forced to step into the market and buy those government bonds to stop the yields from rising any further. And when that happens, the Federal Reserve has to print the money which it uses to buy the government bonds, basically flooding the market with money, which obviously is good for asset prices in general and obviously inflationary too.
Yeah, I've got a thread here because you spoke about something interesting that I had in this thread from X that I wanted to share with you and the viewers. And you said that the economy, the debt is growing faster than the economy, and I think this is what Bravo's research is saying here. They've got a lot of followers, 291,000. They come up with some interesting threads. I might have to subscribe to their research. It looks pretty good. It says U.S. debt is getting completely out of control now. This will not end well. So they're saying here that the debt is gone from like I think it was a trillion in 1966, and I think the debt clock is almost at 37 trillion. And that debt clock, Clive, is going to jump, isn't it? Once they lift the debt ceiling, how much do you think it's going to jump to?
Well, I think they're going to have to borrow $1 trillion in short order because they'll have to replenish the treasury with 800 billion. They'll have to replenish the money that they have not paid into the government pension plans. So another 200 billion from that. So that takes you to a trillion. And then, of course, they're going to have to, going forwards beyond that, they'll have to fund this 2 trillion a year deficit. So, well, I think we're going to see this debt, which is what do we see it at the moment? Was it 34 trillion or 36 trillion? It says.
37 almost. Yeah, I've got the
Yeah,
debt clock. Bring it up.
yeah.
We're
So,
58 billion away from 37 trillion, which isn't that far away.
yeah, so I think in a year's time we'll be looking at 40 trillion.
Yeah, let's see. There's a time machine here, and we can go to, where is it? Let's go to 2029. The debt would be 46.7 trillion. The debt to GDP will be 140. So that's not good. But let's get back to Bravos because he's got a good thread. He says since 66, that's risen from 1 trillion to 36, with a staggering 3.3 plus trillion rise in just the last year alone. It says this rapid rise in debt is now outpacing economic growth. It's what you just said some minutes ago, Clive. So in 2015, US GDP fell below US debt for the first time ever. Today, debt has crossed 36 trillion, but the economy is only 28 trillion. So this is the yeah, that's that moment there. And so the debt is growing faster than the economy. That's a recipe for a disaster. And the other thing I think they spoke about here, let's see, is that when the debt to GDP gets above 90%, growth slows to under 2%. So it's a really bad cocktail. Um, and we can see here that in the 70s, the US was growing at 4% because the debt was like 35% of GDP. But with the debt going up, look at the GDP, Clive. It's and the less GDP you have, the less tax revenues. And I guess that's why these politicians, they're all they say is, oh, we want to get more growth, but they don't realize that to get more growth is not that easy. It's easier said than done, right?
Yeah, and I don't think there's a solution as such that anyone can dream of. I mean, I think the only hope they've got is that somehow this artificial intelligence starts to run the world far more efficiently and produces a lot more and so on. And maybe with that, it might be some way out, but there's no guarantee. But as things stand, we're heading down a road to oblivion in terms of debt. It's going to destroy itself, and those who are holding government debt, in my opinion, will never be paid out in anything that they can spend.
Yeah, the other people that are going to suffer, and that's a lot of people, unfortunately, are people who are dependent on the government for their retirement because even though the UK or the US, they're not going to stop paying the state pensions because they can print the money. It's not going to pay as much. It's not going to be as valued. A pound in a year's time is not going to be the same, and it's not going to keep up with the real debasement, Clive, because I saw yesterday that in the UK they're already revising inflation data or the CPI, and they said, oh, it's because we made a mistake calculating car tax. So, and they, of course, lowered it from not that much, but I think it's significant from 3.5 to 3.4. And talking about the UK, Clive, I wanted to look at a story you pointed out to me this morning, which I hadn't seen, and it's this one here. Reeves hands herself dangerous powers to control pension pots. So that's another thing, before I let you comment, Clive. That's another thing that happens when the debt grows, when GDP falls. Government gets desperate for more money because the debt is getting bigger, the interest rates are rising, uh, and the only way they can finance themselves are either through printing money, like I think is what's going to happen, especially in the US, or by both, like it's going to happen here through taxation.
So if you look at this article, it says Rachel Reeves has granted herself dangerous new powers to direct where millions of savers' pension cash is spent. And now, when we read the article, it's more about where it's invested as opposed to spent. But in short, uh, the government, without any new legislation, will be able to direct a pension fund or pension funds to buy or sell investments. So they can say, we've decided to build a new motorway and we'd like you all to invest in it. Or they might say, we having trouble funding the government debt. We instruct you to buy government bonds. So basically, they can tell with this bill, will have the power to direct pension funds to invest the money in the way the government wants, as opposed to the way that the board of trustees of the pension fund think is the best way.
Clive, there's a name for this kind of activity, and I think it was an Italian politician in the 20s, 30s, and 40s who came up with it. I think, when the state gets involved in business, and that's what fascism, right? And I see that they want people going into private equity and what normal individuals, and that's really dangerous. I think that's a really bad sign too. What do you think about private equity?
Um, well, let's just say a couple of things. First of all, it's illiquid because you can't turn it back into a cash, and it might take. So if you buy a company, a private equity, a non-quoted company, you might think you're going to get a exit in 5 years, but it might take 25 years, or it might go bust. You have no choice. And obviously, when you have a quoted company, shareholders can vote with their feet. If you don't like what the company's doing, you sell the shares, and the directors' options are worth less, so they get punished in a certain way. With private equity, there is very little you can do unless you're on the board of directors to tell to hire and fire the directors. So I don't particularly like it. I know there's a promise of much higher returns in the private equity market, but that's not, as far as I'm concerned, not particularly proven. So I wouldn't particularly recommend going into private equity. There are ways to go to private equity without having to be exposed to illiquid investments. And there are companies in every country which are called investing companies with a stock market quote, which can rise or fall in the market. But I wouldn't like the government telling me, "Oh, Clive, put your pension plan into these unquoted companies, and maybe if they're successful, you get your money back." I wouldn't like that at
Yeah,
all.
yeah. So, Clive, what would you be doing if you were here in the UK and you had your pension pot and it was going to be tinkered with to try to protect yourself? I'm not saying it will protect you 100%, but it will give you a little bit of a cushion.
Well, I don't think anyone young should take the view that the government or their pension plan is going to look after them in their old age. Now, if it does, that's going to be icing on the cake. But realistically speaking, if it happens at all, I think it's going to be very, very meager. So people should plan to look after themselves by spending less than they earn if they can. If they can't do that, they have to find a new way of getting some extra earnings. And obviously, the world is full of opportunities here, so hopefully people can. But if you can earn more than you set, or spend less than you earn, then you should start putting money away into a diversified portfolio. And that can, of course, include gold and silver, which I know is your thing, Mario. But a diversified portfolio of real assets, spend it on your house if you have to, because that's bricks and mortar, and it'll make your house worth more when you come to retire and you sell it, and you can then have a bigger pot of money to spend on the things you're going to need in your old age, like healthcare.
Yeah, yeah, and maybe also look at tax-free ISAs, even though for stocks, even though they are dangerous as well because they can change the rules. I agree with Clive. Investing doesn't just need to be in the stock market, in the financial sector. It can be buying some gold and silver, stashing it away. That's what I've been trying to do in Clive as well, to some extent. And a lot of you have asked, and I've provided like affiliates if you're interested in getting involved for to buy gold and silver here in the UK and in the US. All the details are below in the description. The other thing, Clive, about investing is that, yeah, I said it's not necessarily investing in the financial sector, but also investing in yourself or your family or your property. Uh, yeah, people need to think a little more outside the box, I think, because unfortunately, governments in the West, they're coming after us, after our properties, unfortunately.
Well, yeah, let's talk about investing in yourself. There is one skill that every one of your viewers can acquire in about 1 hour, which will have the potential to boost what they earn very significantly. That skill is called prompt engineering. Now, prompt engineering is the manner in which you give instructions to an artificial intelligent agent like ChatGPT, Claude AI, Manus, DeepSeek, Gemini, Perplexity, and so on. Obviously, everybody on the planet can give a simple instruction like reply to this email, but there's a lot more to it than that. And if you are able to give very good and clear instructions by becoming what's called a prompt engineer, you're likely to become the person in your office where you work, if you're in an office, who's perceived to have that particular skill set and therefore much more valuable to the bosses because those who have that skill set will be increasing their output significantly compared with those who don't have it. And those who increase their output will be not only the survivors, I suppose, but also potentially very much in demand by other employers because every company now is desperate to hire people who could master the skills of artificial intelligence. So prompt engineering, Mario, I think is something that people can do to improve themselves. It takes not more than 1 hour to learn the basics.
Yeah, I hadn't heard of that term. I guess it's a little bit, if you go back 30, 35 years, people who were working in IT, they became really quiet in project management. So the other thing, Clive, I think that's important in terms of investing and looking after yourself is your health as well, and what you eat. That's I don't talk about that much, but it's really important because if you're sick and you're not well, it's really hard to do things. Um, let's look at yeah, anything you find interesting that's come out this week, Clive, that you wanted to talk about?
Well, when I wrote the article about the silver price going up yesterday, I had quite a few people write to me on LinkedIn and say, I want to buy silver mining stocks. What stocks shall I buy? Now, I'm reluctant to name specific stocks. I don't really want to get into the arena of investment advice, but what I'm saying is this is how you do it. You can go and look at the silver ETFs. For example, there's one called SIL, another one called SILJ. That's a symbol. I think it's called the Global X Silver Miners. But you put in that symbol with the word followed SIL, followed by ETF, and followed by the word fact sheet. And you'll get to various website sites which have got the fact sheet for the ETF, which is invested in silver miners. From that fact sheet, you will then be able to see the largest 10 stocks in which they're invested, and then you can pick the one you like if you want to invest in silver miners. That's the way forward. So you're looking at the Silver Miners ETF, I think it's Global X Silver Miners, and then you're looking at the fact sheet to see what stocks they're invested in, and then you've got a choice of stocks to look at, and of course you can go and look them up on Yahoo or whatever you like to find out if they're making a profit or how successful they are. That's one thing. The other thing I'd just like to mention, or two more things. One, anyone who's interested in prompt engineering, I've written a paper on it. It's 4 sides. It's got more or less everything you need to know. So it's 4 A4 sheets of paper. It's in PDF format. If you write to me on LinkedIn, I will be happy to return that to you via LinkedIn messaging. I don't use email because, or WhatsApp or anything like that.
Yeah.
So you're welcome to that. And the last thing I'd like to say, Mario, is any second now I'm about to upload a video about why investing in value stocks will be a profitable strategy. It explains how to find value stocks and why it's going to be profitable for those who are not very familiar with investing and how you get there. What is a value stock?
Yeah, and I think the miners, gold and silver, are kind of value stocks these days, aren't Clive? Because I heard someone say that some mining stocks are priced as if gold was still at $2,000.
That's absolutely correct, Mario, because the analysts only do a write-up on gold mining stocks straight after the latest earnings report. So that most of these earnings reports were the earnings reports for the 31st of December. Now, some companies do report quarterly, but many of them are reporting just twice a year. So that earnings report will have been in March or April, based on the results of end of year, which are published in March or April. So their report, which is also looking forwards and backwards, will be looking at the gold price as it stood back then, which was a much lower than today's, and their forecast earnings per share will be therefore based on that much lower gold price. So if you want to try that, what I did to test this, I took a whole bunch of gold mining stocks and pumped their numbers into Grok AI. Grok AI is Elon Musk's AI, and asked it to work out what the earnings per share will be next year based on various gold prices from 2000. I used 2,800 as my base, but I also used 3,000 and 3,300. But based on $2,800 an ounce, which is way below today's price, many gold mining stocks next year will be on price earnings ratios well below 10 and one or two below a price earnings ratio of below 5. So if you think about it, we'll have in a year's time, we'll have what looks like growth stocks because their earnings will have gone up with a very low multiple. So what's going to happen between now and then is all the algorithmic computers which are designed to buy value stocks with
Yeah.
growth will be latching onto these. So the price of mining stocks, gold mining stocks, should be rising if the gold price holds up.
Yeah, so there will be the new value stocks, but then then the PE will probably rise as well as more
Yeah,
people get in, right? Uh,
the P will rise because, well, P will go, in one sense, go down as they report the next results. But as the price rises faster, the P will go up because the P is a function of the price and the earnings.
yeah, yeah. So interesting times. Um, any view on the general stock market, Clive? And you just a question. You said the Fed the rate cut is priced in. Is that for the next meeting or?
No, they're expecting it the meeting after next.
Okay. Today will be an interesting day because we get the non-farm payroll numbers, the jobs numbers. And if that's very weak, it might prompt the Fed to cut rates. I think their next meeting is sometime in the middle of this month, June 18th.
Yeah,
And
it's about 15 days away or something like
yeah,
that.
and Jay Powell has just been to the White House last week. So if we had a weak ADP number as well, even though that number doesn't necessarily it's not a good harbinger, great harbinger for today's number. But I think that's the next big thing to keep an eye on, Clive. And with that, I'm gonna wish you a great weekend. Don't know if you'll be able to make it on Sunday for the live stream.
Yeah, it should be there, Mario.
Okay, great. And to the viewers, I wish you all a great weekend.
Thanks, everybody. Thumbs up.